We're just talking gold. It's like the topic du jour because it broke out in such a big way. I know that you've taken a perspective on this to kind of look at some of the vol metrics that are happening.
Absolutely.
What do you see?
So a couple things. I was in Toronto actually yesterday, and everyone there very bulled up on gold. It's also in Canada.
Right.
What we're seeing is a few things.
Well, hometown bias.
Absolutely. Every time I'm there, people are really bulled up on gold. But a couple things. One, shares outstanding towards the top of the range in GLD, meaning retail is definitely there. They're buying gold. Futures positioning extremely long, and then the metrics we look at, the volatility, calls are very well bid to puts, to the point where, let's say gold is trading at $100, the 105 call, you can sell one of those to buy 5 times as many of the 95% of spot options.
So betting on 5% upside is basically as expensive.
It's 3 times as expensive as buying its 5% downside.
Wow. All right, so the skew, basically what you're describing is now tilted towards bullishness, bullish
Absolutely.
Positioning, and some of the other metrics are as well.
Which is unusual, right? Because the market's up a ton. You know, as this rally sort of happened, but you could see people are nervous about central bank policy, they're nervous about geopolitical risk, and gold as itself is a small market cap. So what we're seeing is this massive, I view it as crowding into the space. People are getting longer and longer. And you saw last night, you had the bombs go off overnight, gold had this huge rally and then ended up trading down in a kind of a weak close. And so to me, it's like, if I'm long gold, what I would be doing is selling calls, buying puts as a hedge, collaring my position, because you get paid so much for that upside because there's so much demand right now.
Yeah. Now, what about the gold bonds relationship? Because they traded very closely throughout 2019, and then with this latest surge in gold, I said it was basically going AWOL because it didn't really line up with anything, even other safety assets like bonds.
Totally. The one thing you should look at is real rates.
Okay.
So real rates are breaking down. U.S. real rates just touched zero yesterday or 2 days ago.
So this is including inflation.
Exactly. So if you track gold with real rates, that relationship actually does check out. Now, my view, if growth does pick up, there's going to be some pullback in some of these risk-off assets like gold, and that relationship between treasuries and gold should start to act a little more normal. So it's like, from our view, it's like if you're going to hedge, if you need to hedge, I wouldn't necessarily buy gold. I'd actually think about buying TLT calls or just treasuries or something else that hasn't rallied to the same extent. One
of the charts that we've got here combines some of the work from your guys' macro team, I would think here, because you're looking at global manufacturing PMIs. The big question out here is, all right, are they bottoming? Are they coming back? Are they about to turn south? It's probably the most important question in the market right now.
Our firm view is they're going to turn up.
Okay.
And what that means, so obviously a lot of people talk to us, well, the S&P's already rallied a ton, rallied 30% over the last whatever year. So how much of the returns are still left to get out? Our view is like, you're probably not going to get much of a return from PE multiples expanding, but you'll get it on the earnings side. And where we're sort of directing clients is you should start looking to get longer, higher quality cyclicals. And one space in particular we like is industrials. And that's, again, when we talk about shares outstanding in ETFs, so that's like the retail. What is retail buying? That is towards the lowest percentile of the last few years. So people aren't in industrials. But we think this is the year where they should outperform some of the more growthy sectors and some of the more defensive sectors like staples, utilities. And so we're sort of suggesting clients look at XLI calls in that area of the market.
You're basically answering the question that I was asking at the top of the show here, which is, if we get past all the geopolitical stuff the last couple of days, which market do we go back to? The kind of reflationary trade, which is the one you're more aligned with.
Absolutely.
Or now, there's also, though, this kind of thing that does, I think, also tie into gold, which is the rate cut that's getting priced into the market now, which seems to be at odds. If we go back to that PMI chart, if that thing ticks up, then why are we expecting cuts?
Well, I think the Fed did a pretty good job of saying, don't expect any hikes. We could cut if need be. So they've gone to the back burner. So it's like, I mean, our firm view is like they're more likely to cut than they are to hike, but it's unclear whether either will happen. Do you know what I mean? It's skewed to the downside.
So if you had, you don't know, but if you had to guess.
Right, and don't worry about the Fed getting in your way.
Right.
That's the other thing. It's like, if don't have the Fed as like, oh, I'm not going to get long because of the Fed.
Okay.
That's not the right way to think.
So the PMIs are overlaid against a dashed line here as well, and you guys are looking at global short rates. So what does this chart show us here?
This is basically just telling us that over the last year, so we're pushing forward what's happened over the last year, rates have come down globally. So we've had cuts in the US, we've had cuts abroad, and because of this tends to push PMIs higher, this tends to lead PMIs. So because, just think about this, like if a year ago rates went down, you're not going to spend that money immediately. It takes a little while to work through the system, and this is the model that our firm sort of looks at on the eco side and on the strategy side of like why we like cyclicals relative to defensives for the rest of the year, barring no geopolitical
Right.
disasters.
Barring some unforeseen incident. Okay, so as it pertains then again to the trading element, because you mentioned the gold, I want to come back to that because we do have the chart that you just pulled here from the Bloomberg vol function you guys are looking at, and you can see the skew that's really blown out of proportion. And your point here is to do, if you're a gold bug, to basically start hedging while you can, while it's cheap.
Absolutely, because to me, it's the reason you hedge is to get you longer. So, for instance, you can sell a 5% out of the money call, buy 3 times as many 5% out of the money puts for even money, not going out 3 months. So to me, it's if I'm long 300 million notional, you can sell 100 million notional of upside to hedge out 300 million of downside. So you still keep your upside, but all of your downside's already hedged out. So it's this is, to me, is a no-brainer way to stay long this spot, to stay long this rally, because I understand that gold can be a momentum trade,
right?
And you don't want to miss any of it.
It seems like it is right now.
No, absolutely. You don't want to miss some of it, but at the same time, it's you're getting paid for that upside so much to lock in all of these gains that you've achieved in the last 4 weeks.
Right.
So.
Okay, so there's another thing here you said that I think is interesting, which is people don't believe that the economy can accelerate or come back because they go, oh, well, stocks have already run so much. Do we need to sort of disentangle, do people need to think about the economic potential and the stock returns potential separately, given what we saw last year where stocks were just driven by multiple expansion?
Absolutely, and at the same time, it's the difference between, if you think about December of 18, we had a Fed that just hiked. We had the Fed that wasn't necessarily behind us. And so there was a lot more fear baked into the market. Multiples contracted massively because we had actually a great earnings year in 18. Mm-hmm. In 2020, we don't really have that issue. You're not going to have to worry about the Fed coming in and blowing up this rally. So from our point of view, that's one risk we don't have to worry about. Now, at the same time, you can make the RMPs are a little bit frothy, but earnings now are going to hopefully compensate you for that PE risk, and that's what we're expecting this year, earnings to pick up. You're not going to get that multiple turn, so I think our firm view is 3,400 roughly in the S&P for the year, so up 7-8%. I think that seems very reasonable, and at the same time, on an option seat, calls are basically as cheap as they've been since 2017. So it's we're saying obviously there's risk, there's geopolitical risk, the market looks a little frothy. It is extremely cheap to get long the market via calls.
Now, what else in terms of positioning, skewness within the equity market? Is there a sort of euphoria starting to build? Is there a lack of paranoia?
It's funny, I actually see the opposite.
Okay.
Puts seem very, very well bid to me relative to calls. So it's the opposite we see in gold, right? Puts are very expensive in the S&P relative to calls. And it's really odd, right? Because we're rallying and you'd think there'd be some euphoria.
And our VIX is 13 right now.
Yeah.
13.06.
Yeah, you'd think there'd be crazy euphoria. We got to get long. It's literally the opposite. We're seeing people are hedging a lot. They're still nervous. There's all this headline risk. Jan 15th is when the phase 1 trade deal is supposed to be signed. On our desk, we've seen hedging there for that event. So because of this, and because of also March 3rd is the other big event, the Super Tuesday, we're seeing a ton of hedging for these events. Puts are actually very expensive relative to calls. So opposite of gold, I'd be selling puts in the S&P to buy calls to get long.